Good morning, everyone. My name is Eloise Hall, Key Account Manager here at Kensington Mortgages, and welcome to our latest webinar, Flexi Fixed for Term, How You Can Place More Business. This webinar is a little bit different to our normal ones, where today we'll be specifically focusing on our new product, Flexi Fixed for Term. In January 2022, only a month away, believe it or not, we will be returning back to our normal webinars, focusing on the whole of the market. But before we get started today, I'll just run through some brief housekeeping tips for you. The first thing to mention is that on your screen, you will have a control panel. Within your control panel, you'll have the option to submit questions throughout today's session, and there will be a live Q&A today, so please do submit any questions that you may have throughout this session. If you do come across any IT issues, please do utilise the same function and get in touch via the chat, and we will work with you to try and resolve any problems that you might be having. But classic IT tip is to simply log off and log back in again using the same link. We do find that desktops and laptops do work best with this system, so if you have the option, please do log in via one of those. Also within the control panel, you will have a handouts tab where you will see a handy one-page document all about flexible fixed for term, which is available for you to download so you can browse at your leisure. We will be emailing that out to you after today's session anyway, but along with your CPD certificates as well. We do expect to run to around 30 minutes today, so your CPD certificates will reflect this. We've got a lot to look forward to today, so let's take a look at the agenda. Craig McKinley, Kensington's new business director, will firstly be talking us through why we've created this product and why we believe this will fill the gap in the market, allowing you to say yes to more customers that you would otherwise have to turn away. He will then discuss what product details are like for flexible fixed term and what we mean by flexible fixed term and how this differentiates from our existing range. And I'll then run through some case examples. We've then reached out to the sourcing systems who have kindly given us some demo videos to show you how you can source for this product. And we will then close with a live Q&A session with Craig and myself. So please do submit any questions that you have throughout today's session today. So first up, please let me hand over to Craig to talk us through why we have developed this product. So over to you, Craig.
Thanks, Eloise. So I'll take a few minutes just to talk about why we've launched a long-term fix, and then most importantly, what it is and how it works. So there's really three problems we're trying to address with this solution. So the first one is around how difficult it is for people to raise a deposit, particularly first-time buyers. So the average deposit's risen by £11,000 during COVID. So it's now £57,000, which is a huge amount of money. And when you think that most renters are paying between 25 and 50% on average of their income in rent, it's really, really hard to save any money, never mind that kind of money. So unless you're lucky enough to have the bank of mum and dad, the deposit remains a real challenge to get more than 5%. So the second part of this, the second reason why, and the second problem we're trying to solve is affordability. So you can see there on the chart, house prices are now in London are 12 times the local income, 9 times in the southeast, and even 6 times in Yorkshire. And that's really hard for people to get that kind of money. So even if you do have a decent deposit, if you can get to that 5% deposit minimum, you may still be locked out of the market because you haven't got the affordability you need to get onto that housing market. And as you can see at the bottom there, on average, if you look at the average house price being worth about £270,000, we looked at the average deposit of £57,000 a second ago, you would need £47,500 to get a mortgage that made that work. But the average income in the UK is about £30,000. So there's a big, big gap there. So this product aims to look at affordability as well as deposit. And the third challenge is we know people are more and more concerned about rising interest rates. There's no question we're at all-time record lows, but there's also no question that those will eventually rise. And in fact, the Bank of England have said there'll be rising interest rates fairly soon. Now, don't expect them to go up massively in the next few years. I think it'll be nice and slow and steady, but we have to bear in mind, we're talking about 20, 30, 40-year fixed products here. And over the last 30 years, the average base rate is 4%. Which means the average mortgage rate will be between 5 and 6%. So over a long term, you'd expect to revert to the mean and rates to be similar to that. So some people are now worried about that and thinking, well, rates are really cheap at the moment. How do I lock into a cheap rate? We've seen mortgage rates start to increase. There's less rates under 1% now. And we've also seen people just worried about inflation generally, huge increases in energy costs, fuel, etc. So definitely another trend we're starting to see as people worry about the long term. So they're the kind of three reasons why. So in summary, we're worried that the average age of the first-time buyer is increasing. So it's now, I think, about 35 years old. House price growth is continuing to outgrow wage growth. So it gets harder and harder every year for those first-time buyers to get on the ladder, especially in the south. You've got Help to Buy ending next year. Now, Help to Buy has been a great solution because it fixes both affordability and deposit, which is one of the reasons it's been so popular, but it's already been restricted to first-time buyers only. And the regional price caps, I know, are causing a lot of people a lot of challenges. And if you're not lucky enough to have the bank of mum and dad, which of course not many people are, and certainly not to the tune of £57,000, it becomes a real problem. So we've got a situation where the problems are getting worse because house price and affordability are getting worse. And the biggest solution, Help to Buy, is going. So it's a big problem. So what is Kensington's solution? So we've done some research. We researched 4,000 consumers when we were working on this product, deciding how to build the product. We talked to 2,000 renters and 2,000 homeowners, and we asked them, would they be interested in a long-term fix? And 80% of them said they would be, and 70% of renters said they would be, which is no surprise. Interestingly, those who said they would be interested said they'd be prepared to pay a little bit more for the certainty and the potential rewards that a long-term fix could bring. And that's about £100 a month, though we are prepared to pay more. However, as you'd expect, still a bit concerned from customers, worried about penalty fees, being locked in. Nice idea, but very cautious. People are used to a 2 or 5 year fix. So this is a lot to educate and explain people on. So let's talk about what Kensington have done and explain our product a bit more. So this is our Flexi Fixed Term product. All the headlines, we've had a lot of great coverage in the press. We'll talk about the 40-year fix. And yes, we do have a 40-year fix, but really this is from 11 years up. So don't just think it has to be for customers looking for a 40-year fix. It could be 11 years up. And we'll go to 95% loan to value. So it really does solve that deposit issue for first-time buyers. And one of the key things is it also helps affordability. We will go up to 6 times income for first-time buyers. Obviously, to get 6 times income means you'd have to have no commitments, so people will tend to be a little bit less than 6 times. And the reason we can do that is we can give an affordability boost because we don't have to do the normal Bank of England stress rates. For us, we'd be stressing about 8%. With this, the pay rate is going to be between 2.8 and just over 4%. So that's what we use as the stress rate. The rate never goes up, so we never have to worry about the customer paying SVR or what happens in future if interest rates go up, because this rate is fixed. So we can afford to do better affordability. And that's great for brokers because we're all very aware of the difficult conversations you have with customers who come in and see you and say, well, I'm paying £1,000 a month on my rent, and I have been for years, and I can prove I've paid it. The mortgage we've been discussing is £800 a month, but you're telling me I've failed affordability. That doesn't make any sense. Now, we all know that's because the lender's doing a stress rate in the background and might be looking at whether that customer can afford £1,400 in rent, but you end up in a strange conversation that the customer just doesn't understand. So this gets rid of all that. Competitive pricing. For Kensington, this is pretty much high street pricing. 95 LTV starts at 3.7%, which is pretty close to high street pricing, much cheaper than our 2 or 5 year 95 product. So don't think that, oh, this is a specialist product, it's going to be more expensive. This is a different product range with different pricing. It's portable, which is critical. So customers can move this, and they can move this with no ERC. So there's no ERC if they move it, and if they want to remortgage, there's also no ERC. And I'll talk more about our flexible ERCs in a second, and then we'll also talk about the enhanced prop fees that come with this product. So let's look at the ERCs, which are clearly the main area of concern when you talk to customers about this. And signing up to a 20 or 30-year mortgage, what happens if something changes? I don't want to be locked in. Well, we tried to think hard about this. So when the customer moves, and of course most customers will move, during a 30, possibly even a 40-year term. When they move, they have a choice. They can either take this product with them and they can port it, and if they need to borrow more money, if they're moving up the housing ladder, potentially they can do that because we will be offering a further advance. They could keep this product and put a further advance on top, or they could remortgage away. If they remortgage away, there is no prop fee. If they redeem in full by their own funds, so if they get a big bonus, so they can pay off their mortgage, if they have lots of savings, if they get a gift from parents, if they get an inheritance, and they can pay this off in full, there is no ERC to be paid. They can overpay up to 10% as well with no ERC. And if there's a death or a critical illness, that's also no ERC. So you only pay the ERC if you overpay by more than 10% in a calendar year, or if you remortgage and stay in the same property and move to a different rate with a different lender, then you'd pay the ERC. So we think it's really fair and really flexible. So hopefully that addresses the consumer concerns about being locked in. So then the broker concerns, so prop fees. So we do think there's some additional work for brokers with this. We think when you do things like your illustrations and advice, if you're talking to a customer about a 30-year mortgage, you need to compare that to a 10-year and a 2 and a 5-year. So we think that's a bit more work. Potentially the feedback from some brokers, because this is essentially a new category of products, there may be a little bit more oversight. You may have to pass it to one of the directors in the firm to kind of rubber stamp it. So there might be a bit more work there. So we think it's only fair then that brokers get an enhanced prop fee. So we were paying 0.75% rather than normal 0.5%, and that 0.75 gets shared between the broker and the network or club. Because if we don't pay that, if we just pay a normal prop fee, we think we're basically penalising you for selling this product because you're doing more work for the same amount of money. And then there is a prop fee paid on porting applications. So if you do port, we mentioned when the customer moves house, you can port or remortgage away. If you do port, you get another prop fee. And then further advances are available after a year, and you also get a prop fee on any further advance. And we think, bearing in mind that these customers, something will happen in these customers' lifetime. If they take a 30-year term, they'll either move or need more money, as most customers do, and that's an opportunity to earn a prop fee. And I think the key thing I'd say about this is the way we've tried to aim this is to grow the market for you and your customers. So this really is for the kind of customer that walks in. You'll all have had the conversations where you say, look, I know you want to buy that house, you want that new build property, whatever. I just can't get you the affordability. You need to go away, come back in 6 or 12 months when you've saved some more money, try and get a pay rise, talk to your family and friends, see if you can get some money from them, etc. This is for those customers. So hopefully that means instead of turning them away, you can help them. And I've even spoken to one broker who actually said he was going to go through his last 2 or 3 months of affordability fails and look to see if he could help those customers. And if he can help any of them now, what a great conversation to be having. So that's really what this is aimed at. We want to grow the market for you. So let's talk about criteria, because the criteria on this is slightly different to us. So it's a different product range, so we've got different criteria rules. You have to be employed for 12 months. It is up to 95% LTV. 90% is the limit for new build and 85% for new build flats. And then self-employed for 2 years minimum, which is different to our normal criteria. And we'll use an average of those 2 years, which again is different to our normal criteria. So this is different to our standard Kensington criteria. So please check the criteria before you submit or phone the BDU. So just to bring that to life a bit more on the next slide, here we go. I'll just compare it to our best selling products. So most of our business comes in on our Select range. We do have 3 or 4 different credit ranges. The Select is by far and away the most popular. And then on the right hand side, I've put the difference in criteria there for our Flexi Fixed for term. So you can see there, default's acceptable if they're older than 36 months and secured loan arrears, that's fine. CCJs on this product are not on the credit report for 6 years or over, which is different to Select, which is 3 years. Different on unsecured credit status as well. No DMPs, and payday loans have to be more than 2 years. However, we still don't credit score on this product or any of our products, so bear that in mind. Still underwritten by a human rather than an algorithm. And like I say, we will go up to 95 LTV, but it is worth understanding this is different criteria to our standard criteria. So that's me. I've taken you through the why we're doing this and what it is. Now I'm going to hand over to Eloise, who's got some really good case studies that really bring this to life with real life people. Thank you.
Thank you, Craig. Some excellent highlights and explanations of our new product there. I have a few case examples that I would absolutely love to run through now, just to bring this product and its criteria to life. So our first example here is our failed first-time buyers. Chris and Julie are in their early 30s and wanting to find their first home that they can grow their family into. They've been able to save a 5% deposit themselves, and with the traditional market affordability on a 2-year fixed, that would be £273,000 that they would be offered. We've calculated this by looking at the market average across lots of other lenders over both 2-year and 5-year fixed. So the average that they could get in the market would be 273. But now with Flexi Fixed for Term, these first-time buyers can get an additional 117,000 towards their first home, total borrowing of 390,000, meaning they can now afford a 4-bedroom home, or even look outside of their hometown in South Wales over the bridge into Bristol, which was otherwise not an option. Next up, we have a single applicant who is seeking mortgage security. Jade is a professional working in central London and wants to purchase a property close to her office. She has a 15% deposit from her savings and some from a family gift, and has a healthy salary of 91,000. On traditional stress testing, the rest of the market would offer Jade 406,000. But as Jade is also wanting to ensure that her mortgage payment doesn't change over the term, she would also benefit from a £130,000 boost in affordability when selecting Flexi Fixed for Term, meaning a total borrowing of 542,000, which is the difference between a 2-bed and a 3-bed home in London. There are, of course, reluctant renters as well that this product could help. We have here a family of 4. We've got Michael and Alexis. They have 2 children and a 10% deposit. They've been forced to rent as they really want their 2 children to have their own bedrooms. And with 33,000 joint income between them, the average offering that they can obtain is 131,000 with traditional 2-year stress testing. But with Kensington's Flexi Fixed for Term, they can borrow a further 66,000, so a total of 197,000, which, as the average 3-bedroom home in the northwest, where they're wanting to purchase, is 175,000. This family can now move into their own home with a bedroom for each of their kids, rather than continuing to rent. Our last example is Sheng and Sue. They are both self-employed and second-time buyers looking for a new home that offers them a little bit more office space, as they are now both self-employed. And as they're self-employed, they're also hoping to fix their interest rates for the term of the mortgage. So that is exactly, so they know exactly what to expect when they are looking at their mortgage finances for the future. They currently have 30% equity at the moment and £71,000 in income, which is an average of their last 2 years self-employed figures. On traditional stress testing, they would be offered 287,000, but with Flexi Fixed for Term, they could borrow up to 317,000, an increase of £30,000, meaning they can now consider properties with that additional space they want for those 2 offices, as well as even a guest bedroom. So I hope that brought to life some of the examples of how Flexi Fixed for Term can help you help more customers. And now I know this is a very different product, so we've reached out to the sourcing systems to show you how you can source for this new product range. So here's a quick 1-minute demo for each of those. So let's take a look now. So first up, our regular users of Mortgage Brain will recognise this screen. So in this example on this sourcing, we're going to keep it residential and keep as a home mover. The details we're going to put in, as you're very familiar with, we'll have the date of birth and salary. The property price in this example will have at 200,000 with a 10% deposit, so 20k, meaning this will be for a 90% LTV product we're sourcing. The term being 35 years, and we will show the cost over those 35 years as well. The initial rate type that we'll be sourcing for is fixed. So when we click onto product filters at the top in the tab there, the key thing that you'll be making sure that you tick and highlight is lifetime under attributes. Then once you've done that, click onto the results, and then you will see that Kensington have sourced a 35-year, 90% LTV product. So that will be top of the pops there, as you can see on the sourcing in comparison to our competitors. So that's the Mortgage Brain sourcing for what you'd be looking to do. Next up, we have Trigold. So for those of you that use Trigold, you would start your mortgage quote as you normally would, and then input the details as you normally would. In this example, we'll just tick the boxes to ignore the date of birth and not to include income. But in this example, we're going to make sure that we're doing a 35-year term again. But this time we'll do a value of 250,000, again with a 10% deposit, looking for that 90% LTV. And on this, what you need to do is click onto the loan details tab, make sure you're selecting fixed, and then underneath initial term, click the drop down to term. And then, of course, you will see Kensington products sourcing there for you. So really important to make sure that you are looking under the drop down and sourcing for fixed term, and you will see Kensington product sourcing. So next up, for those of you that use 27 Tech, you will go into the mortgage application as you normally would, clicking on underneath source and clicking into mortgages, and then we would just start the process like you would do with any of your customers. So in this example, we'll do a purchase, standard residential. The purchase price we will use is the same as the last example, so we'll do a 10% deposit here. So purchase price of 250,000, loan amount being 225,000. Source deposit will select the savings, but again, putting in that loan term 35 years and selecting a repayment method. We'll then have to input the client details just like we normally would in any application. So we will have Mr. Joe Blogs here, classic example. And then what we will click onto, so the crucial bit here, is clicking onto the filters, ticking that it will be a fixed product. And then under the product period time, you would select term product. Once you've selected that, you'll scroll down to search for mortgages. And then when the cog has turned, you will see that Kensington Mortgages Flexi Fixed Term will source, retrieve all those product details, and you'll get all that information at your fingertips. As you can see under the product conditions, that highlights all the details that this is a fixed or term proposition. That's all three of our sourcing videos. So now we move on to the Q&A segment of this morning's webinar, and we've had some excellent questions already coming in. So please let me welcome Craig back onto screen. Hello, Craig. You ready for some quick fire questions?
I'm a bit nervous now.
No, we've had some great questions so far. So one question that's already been submitted is saying, customers don't tend to come knocking on the door for long-term fixes. So as brokers, how do we discuss this with them? Okay.
Well, I think the key thing is we know that there's not huge demand for, some lenders we've got a 10-year. There's not a huge demand for customers. Customers kind of are used to working in 2 or 5 year cycles. So I think the key thing is to expect customers to commit to a longer term. There needs to be a benefit. So with this, there's either the benefit that you're locking in historically low rates. That some people will see that as a benefit, but that's not for everyone. But we think for this one, really, the affordability is the benefits, that kind of affordability boost we can give. And it really is, like we said earlier, it's, I think the real sweet spot for this product is for those customers who you're turning away today because brokers are saying, look, I can't help you, you need to come back in 6 or 12 months when you've saved some money up. It should be, hopefully, it's one more customer for brokers rather than having to turn them away. So it's explaining that to them. Look, you've asked for £300,000 for because you found a certain property. You can't quite afford that with traditional lending, but actually there's this different product that I can help you with. So it's educating them because it is new. So the reason we did this webinar is we've had lots of questions. There's lots of interest, huge amount of interest from consumers. We don't sell direct to consumers, but the consumer side of our website's kind of blown up in the last couple of weeks. So there's lots of interest, but we wanted to educate brokers about what the product is so they can educate their customers because it is a new segment and people have lots of questions and no one really understands it. So yeah, I think there's definitely a bit of work to just try and help customers understand that.
No, absolutely. Thank you for that. And definitely one of the key subjects that we're seeing lots of questions coming through on is around the ERCs. So absolutely, presumably one of the biggest concerns for customers will be the ERCs. And I know brokers will hear concerns around even 5-year fix at the moment. So can you just reiterate really what makes this product different around the ERCs?
Yes, I mean, you're absolutely right. When we did the research with customers, that's the first thing is that some of them like the idea of certainty, so that it's not going to go up. They like the idea of not having to go through the pain of having to remortgage every few years. So they like the idea, but absolutely people go, well, but does that mean I'm locked in? What if something changes? What if I have to get out? So we've really tried to think hard about that, so that you only would pay the ERC if you remortgaged and stayed in the same property. And we think it would be unlikely people would do that because the rates are fairly competitive, and they are longer rates. So rates will probably go up in that time. So the rate, as this is fixed, looks more and more competitive over time. And also, if you have used this product for an affordability boost, you might not be able to remortgage away. So we think it's less likely people will want to remortgage and stay in the same property. And pretty much any other circumstance, they don't have to pay the ERC. And then the other thing is, there is the other option if they do stay in the same property. I mean, the ERC is only if they remortgage. If they do get an inheritance, if they get a big bonus, if they save up a load of money, if they can redeem in full, that's also fine. So we've really tried to reduce that, because clearly that is going to be the main concern for customers. But we think it's we've tried to take away most of the reasons and make it relatively unlikely that the customer would have to pay an ERC.
No, excellent, thank you. And one of the other questions you had through is around flexible fixed for term having a different funding model. So how does that impact the pricing of the products? I know you've mentioned rates at 95%, but where are the other rates sitting?
Yeah, so I mean, the good news for us, because this is a different funding for model for us, we normally have to go out to the securitization market. We're working with a very kind of prestigious life insurer on this product who is funding this. And that's allowed us to actually be relatively cheaper than our own core range. So the 95 is the best example. Our rates start at 3.7%. Our 95 and our 2 and 5 years are in the 5%. So it's actually usually consumers and brokers would expect the longer the term, the higher the rates. Whereas actually this is the other way around, because it's a different funding model. So our rates are very competitive. We start at 2.8% for our 60 LTV, and it is worth mentioning, obviously there's a lot of focus has been on the 95 LTV, the 40-year term, but actually we're seeing a lot of interest at the lower LTVs, because we do start at 60, and that's actually the lower terms, because this is from 11 years to 40. It's not, like I say, the headlines have all been about 95 and 40 years, whereas actually we go from 60 LTV and 11 years. So there's a real range of solutions for customers.
Oh, brilliant, thank you, Craig. And we are unfortunately quickly running out of time this morning, so I'll have to end the Q&A session there. If there are any more questions that we didn't get a chance to cover, do not worry, we are working behind the scenes now to get you a response. When you do exit the webinar today, you'll be presented with a survey, so please do take the time to fill that out for us and let us know what you want to hear about next. In January, we will plan to return back to you with our normal webinars, focusing on providing you with the latest news and updates from within the market. So please do let us know what topics you'd like for us to cover. The webinar today has been recorded, so if you've missed any moments or wanted to share with any colleagues, we will make this available to you later on today. And if you haven't already, please do follow us on LinkedIn, where you'll receive our latest webinar and product news. But speaking of product news, we've made some great enhancements to our mortgage range in the last few weeks. So I'll publish some of those highlights on your screen now for you to review. But thank you so much for your support and for your attendance today. But that just leaves me to say Merry Christmas.
Thank you.